members, it's June 21st, weekly review, and what happened last week. We had the market work its way higher. We've seen this all the time, right? I mean, it's just a continuation of the move up to the upside. The leader, NASDAQ NDX. Elsewhere, you know, it was gains across the board, but at the same time, the bounce was concentrated in these areas. And if you look, you know, at the sectors, you can see it clearly. Biotech really took off last week. The semiconductors back up towards the highs. Technology in general at the highs. And then communication sectors also contributed a little bit. You didn't really see a lot to the downside. You just saw some of the safety stuff to the downside. The energy, of course, has its own problems. Real estate down. You know, this is what's driving it. It keeps the market afloat. And until that changes, market's going to stay where it is. Okay, let's go back to something we started about 2 weeks ago. It was 2 weeks ago Friday that we talked about this idea of a capitulation top, and it was on this bar that we started thinking about it. That Monday following, we saw lower volume, but we saw a higher high, and then after that, right, the market began to sell down. The question last week was, and we were at this bar last week, the question was, okay, are we going to get the continuation? Is the capitulation really what happened up here? In other words, everybody that was short had to cover, give it up? Or were we going to see some sort of a bounce and a continuation on, right? So would we see another one of those stair steps where we continue to work higher? Well, we got to push up, right? And then we flattened out the whole week. And Friday, once more, we saw the sellers come back in and sell this thing back down. Now, they're still in this higher range. There's a range up here now, as well as kind of this range that's down here. And so you're still in the higher part of this range, but at the same time, it's struggling up here. Now, I wouldn't put a lot on this volume because you had quad witching. So, you know, that I think you kind of have to discount with respect to the way that bar looks. But the gaps, the gap down, capitulation, right, this gap area here still is in effect. And then the question is this going to actually roll back over and roll back down again? My thought is that we kind of have a mixed picture where this whole thing now is potentially just a range, and this is on a daily chart, it's just a range up here because we got over this bearish retest region. We got over it. That says that what was down is probably sideways. And so if that's the case, then we should expect this range to hold a while longer. Instead of coming all the way down, we would expect it to come down and hold. And when we get to the you know, thoughts of next week, you'll see that that's kind of what I'm thinking, is a push back into this area. But generally, we're kind of stuck up here. We'll see. The conclusion is that the thesis is still alive, but we haven't seen the evidence yet to tell us that that's actually what's happening. Matter of fact, it's just barely alive. If we go to try and answer this capitulation question in a different way, that would be, you know, what would it take to kill it? Well, to kill it, you got to get over this bar's low. In other words, you got to get back inside that bar, and that's 3163.84. We got to 3153, and so we're close, but not quite. If you wanted to do the other side and say, okay, what would confirm the thesis, right? You got to close under that 3000 area. This bar is low. So you either got to close down here, you got to close up here to get out of this range, this tight range that's developed, about 150 point range. Right now, the odds, because this has been an uptrend, right? The odds still favor the uptrend, a continuation. You can't get away from that. That's the trend. Trend's always your friend. And so, you know, when I look at it, it's like, okay, that's the way it is, and that's a counter trend trade we're looking at right now. You know, there's nothing to say that this thing can't just continue. But then again, this range at some point is going to break. And when it does, we'll see which side wins the battle. Now, even if we get the breakdown, remember we've talked about all these swing point lows, accumulating down here. And matter of fact, these accumulate on the weekly as well. And if we don't get down to this area down here, the 2800 area, if we don't get down here this week, we're going to have a swing point low print in about the same place on a weekly chart. What does all this suggest if this actually does break down? Well, there's just an ABCD structure to take it just below the swing point high. Now, that all makes sense because this swing point high would be tested the second time. The first test was here. If we come down again, there'd be a second test. Probabilities are less than a coin flip. That says we should break, and this projects that we would break. And so that would be the projection. Now, of course, it could overshoot. It could keep going. But the odds favor that it would find support in that area at this time. The strong stocks is kind of a different picture, right? In that, I guess, when you think about it, it makes sense, right? These guys have not sold off in a big way yet. And these guys being the NASDAQ, the 100. So the big cap technology, and I throw biotech and semiconductors in that same boat. They're all part of this. They filled the gap, the small gap that was created, right? And they went back up to test this high. They haven't quite got there. If we think about it in a different way, we've had swing point lows print all the way up, but no swing point highs, 0 of those. Well, we got one now. There's a swing point high at this price point. Now, what does that tell you? If you can't print a swing point high, and this was a 3-month chart, remember we do 60 bars, right? 3 months chart, not a single swing point high until finally now. That tells you just how strong this thing has been. And if you can't print a swing point high, you can't stay down for more than 6 days after making a high. And so, that just is a testament, and the fact that we print one finally says, you know what? We got consolidation finally. And so I wouldn't be surprised to see consolidation last a bit longer, and that's why this range becomes so important. And if we're going to break higher, you're going to see the NASDAQ close at higher highs. You're going to see that S&P, as we just talked about, close over that 3163, I think it was. So that's where this is at and what it means. Now, in trying to understand, is this a breakdown? Is it a breakout? Which side's winning the battle, right? You can go down to a smaller time frame. This is a 30-minute time frame. You can go down to a smaller time frame and say, okay, is there something here that tells us what's going on? Well, if we look at it on a 30-minute time frame, bring it back about almost a week, you can see that each of these big attempts, especially this one was a big attempt to get lower, that fails. We can see that over here, this push up actually succeeded. We could see the next push up attempt, based off of this one, that one failed. We failed on another smaller one. We failed on a small down. We succeeded on a small up, and now we have a small down in play that might succeed on Monday. These actually get reprinted, right? So this one would actually come up to here now and would print down. And so it's still alive, but it's been redrawing its C point. But right now, if you look at all this, this is just chop, right? You get up, you fell, you go down, you fell. It's chop. Now, the only successes have been on the upside, though, and that continues to tell us, that the things that are forming, firing, and fulfilling are to the upside, not the downside. What's the key sectors, right? If we look for a key sector, I think it's clearly the financials, right? The financials are the sectors that we should be focused on. This is where we would see, if you go down to sectors, because remember the stocks drive the sectors drive the market. If we look for those sectors that are weak, we know the strong is the tech, the biotech, the stocks. On the weak side, it's the financials. And there's an ABCD structure here, potentially, right, that could take us down and break. But if you come back into this, it's going to be the first time this swing point high is going to be tested, and more than likely this is going to be bought. And so even though these are weak, right, they're likely to get bought. And this is the KBE, so this is the small cap bank stocks. If you look at the large cap bank stocks, same thing. You got a swing point high down here, hasn't been tested. And so again, these are portending weakness. Unlike we're seeing elsewhere, they're much weaker, but the push down probably going to get bought, and that would say that this extension doesn't extend to where it should. It will extend just shy of it. So we'll have to watch the financials for two things. A, do they show us the way down? And B, do they actually extend and fell here? If they fell there, that would be a big thing, because that shouldn't happen. We're always looking for things that shouldn't happen. That should not happen. This should get bought. And so that will be something to focus on as an attempt, A, if we go lower, to tell how weak it really is. For now, it's just long-term consolidation, right? We've got that B point I talked about that will print this week on the weekly. So there's a large ABCD structure here potentially. If we go down, there's still this huge ABCD now to the downside that would still print new lows, but it wouldn't do it on the NDX. It would only do it on the S&P. But that is a dream right now, because right now everything's so strong. The consolidation is this area. I've kind of pointed this out before. If we look at the bottom line, what's going on? It's really a tug of war between these two things. You've got the bank stimulus and the fiscal stimulus against the demand and the supply shocks due to the COVID. And so I would say, if we're going to focus on something, we should be focused on these two things, because these are the two things that are going to tell us something. If we see this diminish, or if we see these things increase in terms of the shocks, or never really return to what they were, then that side's going to have an edge on a fundamental basis. If we print, if new highs print, this is the numbers I was talking about a while ago. If we get prints, we're going to see that fall, the 3163.84. We're going to see the index print a new high at over 155. Then if that happens, right, we should expect this trend that's been still up on a short-term basis to continue. If they don't, then we should see probably a 10% retracement back down to 2900 area. Is about as far as I think it would project. That latter case, though, would put that larger term failure in place, because that would put the B point, not the B point, that would put a swing point low on the weekly chart. And that would give us the opportunity to set up some longer term bearish projections. And remember, that would also put the first larger ABCD structure to the downside actually succeeding. Farm, fire, and succeed. So larger case looks like this. This is that weekly. This is that low we're talking about. If we were to come back, if we were to really start to break down in this print, so say 2-3 weeks out from now, I think these become the targets on the downside. But again, this is not the high runner case. The high runner case still is this large ABCD, right? That takes us up to 37 to actually be the success. Fundamentals, I'm doing something a little differently. When we go over these numbers right now, I don't think the particular numbers mean all that much, because we have so much distortion. So just looking, again, trying to look at big picture, it's really the balance sheet of the FOMC and the fiscal nature of what's happening in Washington. The balance sheet actually captures both of those, because all the Treasury debt issuance is being bought up by the Fed right now. It's almost, it's almost completely 100% bought by the Fed. You can see we moved from 4 trillion to roughly 7 trillion. But there is kind of a flattening. If you pull this in, there's a flattening going on. So this dynamic rise looks to be flattening out now. Whether that's the trend, whether that's anything to do with, this is truly what's going to happen, I don't know, because right now, we've been on this moonshot. But when we had these moonshots before, we had some trepidation, and then eventually you had to come back in and keep rising. If you take the money away, if the Fed starts to tighten up, that's going to severely impact the markets. And it doesn't even have to be a big tightening, because the markets are almost completely driven by what these central bankers are doing. And again, I'm talking about they financing all the fiscal stimulus as well. If we look on the other side, right, the demand shock, there's this consumer spending, right? It's way down. Some of these numbers are huge. They're still huge. This is as of the June 10th. And so we can see as of June 10th, from where we were to where we are, we're still about 11% down overall. Some areas hugely down, as you know. Transportation, entertainment are the big two, restaurants. Groceries up, and that's about it, right, on the spending side. The other main thing has been, and it's starting to look ominous again, is we had the COVID come in. That's caused the shutdown. And then we've been slowly, and this is new cases, we've been slowly drifting down, like we put in a top. And then what's happening now that we're opening up again? These cases are starting to shoot up again. So I know that people are trying to discount this, saying, oh, well, we're doing more testing. Well, that's not really true. Go look at the numbers. It's not really true. What's really happening is we really are spreading this thing. The R naught is over 1 again, and that's causing a spread. Now, the problem is, if you don't do something about this, you're going to get the same thing you saw back over here. You're going to see the same thing happen again, and you're starting from a higher plateau, which means you'll see these numbers continue on up, and that's going to be a serious impact on the demand equation. And so this, to me, is the big news, and I think the markets are beginning to reflect this. They're starting to worry about this number rising as rapidly as it is. We've been opening up for about 3-4 weeks now, and these numbers are starting to reflect that opening. Okay, the final thing here, last week, kind of a split between best case and most likely. If we look at the coming week, I think it's going to be a week of extremes. Either we're going to go extremely to the downside or extremely to the upside, but it's not going to stay in the middle again. My guess is that you're going to test these ranges. We already tested the top. I suspect we're going to test the bottom again. That's most my likely case. If things really do turn bad, this thing finally could sell off in a deeper way. And if, for whatever reason, if we find a reason to run higher, the Fed announces new programs, fiscal stuff is pumped up again, whatever it is, right? It's going to be something from those two things probably that could shoot us up and break this range and start a new run, a new leg higher. That's the way it looks. Have a great one. Stay safe, folks. This is not over yet, and I suspect it's going to be a long time before it is. Take care of yourself, and I'll see you next time.